Ever wondered how businesses account for the wear and tear of their assets over time? Today, we're going to delve into the concept of depreciation, a fundamental principle in finance and accounting that's all about this very process. So, what is depreciation? It's essentially the gradual decrease in the value of an asset over time. This happens as assets like machinery, vehicles, or buildings are put to use or simply as they age. Just like your car loses some of its value each time you drive it, a company's assets also depreciate over time. But how does this affect a company's finances? Well, depreciation is recorded as an expense on a company's financial statements. This reflects the ongoing reduction in the asset's value. It's a way to acknowledge that these assets won't stay new forever and will lose value as they're used. Here's a simple way to think about it. Imagine you've bought a brand new car for your business. You wouldn't claim the entire cost of the car as an expense in the first year, right? Instead, you'd spread that cost over the years you expect to use the car, taking into account its decreasing value. That's depreciation in action. Now, there are a few key points that are important to understand about depreciation. 1. It accounts for the fact that assets wear out, become less efficient, or may even become obsolete over time. 2. It's a method companies use to spread out the cost of an asset over its useful life. 3. There are different methods to calculate depreciation. And 4. It impacts a company's financial statements by reducing reported income and the value of assets. Depreciation also has tax implications. Some governments allow businesses to deduct depreciation expenses from their taxable income, which can reduce the amount of tax they owe. So in essence, depreciation is a way for businesses to spread the cost of an asset over its useful life, while also accounting for that asset's inevitable decrease in value. It's a powerful tool in the accounting world, helping businesses manage their assets and finances effectively. Stay tuned for more on this topic in our upcoming scenes. But why do assets depreciate in the first place, you might ask? Well, there are several reasons why this happens. Firstly, let's talk about wear and tear. This is perhaps the most common reason why assets depreciate. Think about a car, for instance. It's shiny and new when you first drive it off the lot. But as you use it, the engine gets worn down, the tires get bald, and the paint job gets scratched. Over time, the car becomes less efficient and less valuable. This is a perfect example of wear and tear causing depreciation. But wear and tear isn't the only reason. Assets can also become less efficient over time, even without physical deterioration. Let's take a computer as an example. When you first buy it, it's top of the line, with the fastest processor and the most memory. But as years pass, software becomes more demanding, and that once speedy computer starts to slow down. Even if it's in perfect physical condition, it's not as valuable because it can't perform tasks as quickly or effectively as it once could. Last but not least, let's talk about obsolescence due to technological advancements. This is a major factor in the depreciation of many types of assets. Consider a smartphone. When it's first released, it has the latest technology and features. But within a year or two, a new model comes out with even better specs. Suddenly, that once cutting-edge phone is outdated, and its value drops significantly. These are just a few examples, but the principle applies to many different types of assets. From machinery in a factory to a commercial building, all assets are subject to some form of depreciation. Therefore, depreciation accounts for the inevitable decrease in value that assets experience over time. It's not something to be feared or avoided, but rather something to understand and manage. By acknowledging and accounting for depreciation, businesses can make more accurate financial decisions and better plan for the future. Now, you might be wondering, how do businesses calculate depreciation? Well, there are a variety of methods used, and the choice often depends on the nature of the asset and the preferences of the business. One of the most common methods is straight-line depreciation. Here, the depreciation expense is spread evenly over the useful life of the asset. For instance, if a company purchases a machine for $100,000 that has a useful life of 10 years, the company would record a depreciation expense of $10,000 each year. Simple, isn't it? Next, we have declining balance depreciation. This method accelerates the depreciation expense, meaning more of the cost is allocated in the earlier years of the asset's life. This can be useful for assets that lose value quickly. For example, a car might lose half of its value in the first few years after purchase. The declining balance method allows businesses to reflect this reality in their accounting. The third method is units of production depreciation. This method ties depreciation directly to the amount of use or production the asset sees. For instance, if a piece of machinery is expected to produce 1,000,000 units over its lifetime, each unit produced would result in a certain amount of depreciation. This method can be more accurate for assets whose value decreases with use, but it requires more record keeping and calculation. So, you see, each method has its pros and cons. Straight line depreciation is straightforward and easy to calculate. Declining balance depreciation can be more accurate for certain types of assets, and units of production depreciation can be the most accurate of all, but requires the most work. Different methods provide different degrees of accuracy and administrative ease, and the choice often depends on the nature of the asset and the preferences of the business. So when it comes to depreciation, there's no one-size-fits-all approach. It's all about finding the method that best fits your business needs. So what happens when a business records depreciation? Well, when a company records depreciation, it impacts both the income statement and the balance sheet. Let's take a closer look to understand how. Firstly, on the income statement, depreciation is considered an operating expense. So, when a company records depreciation, it reduces the company's reported income. This is because the cost of the asset is spread out over several years, instead of being recognized all at once at the time of purchase. This method of spreading out the cost allows for a more accurate representation of the company's profitability. Now, let's move to the balance sheet. Assets are listed on the balance sheet at their historical cost, which is the price paid for the asset. Over time, as depreciation is recorded, the value of the asset decreases. This decrease is reflected in the accumulated depreciation account, which is subtracted from the asset's historical cost. The result is the net book value of the asset, which represents its current estimated value. It's important to remember that depreciation doesn't involve an actual transfer of cash. It's a non-cash expense that simply represents the portion of the asset's cost that has been used up over time. To put it simply, depreciation reduces the value of an asset on the balance sheet and also reduces the company's reported income on the income statement. This double impact may seem like a disadvantage at first glance, but remember, it provides a more accurate picture of the company's financial health and allows for better financial planning and analysis. In the end, depreciation is not just about numbers or accounting jargon. It's a reflection of the real-world wear and tear on assets, the passing of time, and the inevitable march of progress. Depreciation, therefore, has a significant impact on a company's financial statements, reflecting the changing value of their assets. Did you know that depreciation can also affect a company's tax bill? It might seem like a strange connection at first, but let's delve into it. Imagine you're running a business and you purchase a machine for your production line. This machine, like all assets, will lose value over time due to use, wear and tear, or even obsolescence. This loss in value is what we call depreciation. Now, as a business owner, you're not too thrilled about your assets losing value. However, there's a silver lining to this cloud of depreciation, and that comes in the form of tax benefits. In many jurisdictions, governments allow businesses to deduct depreciation expenses from their taxable income. What does this mean exactly? Well, when you calculate your company's taxable income, you can subtract the amount of depreciation from your earnings. This reduces the total amount of income that you'll be taxed on. To put it simply, if your business earned $100,000 this year and your depreciation expense was $10,000, you would only be taxed on $90,000. That's a reduction in your tax bill thanks to depreciation. The logic behind this practice is pretty straightforward. Governments recognize that businesses need to invest in assets to generate income. As these assets lose value over time, businesses are allowed to account for this loss in value when calculating their tax. This deduction acts as a form of relief, helping businesses manage their cash flow and encouraging continued investment in new assets. Now, it's important to note that the rules and regulations regarding depreciation and tax deductions can vary widely from one country to another. Therefore, it's crucial to consult with a tax professional or accountant who understands the specific laws and regulations in your area. So while depreciation might initially seem like a bad thing, it does come with its perks. In this way, depreciation not only reflects the changing value of assets, but can also offer tax advantages.